Here we go. Yeah, welcome also from my side. It's really unfortunate that I couldn't take my flight this morning. It was kind of like based on my medical doctor's advice. Really unfortunate. Would love to be with you. Anyways, I'm happy that I'm now with you online here, virtual. My relatively brief talk is about risk parity and budgeting with Python. It's not as fancy, I would say, and as current the topic as what you will probably find in the daily financial news currently, right? Where crypto in the second talk is probably the hotter topic. But I think this is still kind of like in terms of I used to give this talk in a do-it-yourself way, and this is still something do-it-yourself. I would say you can take the Jupyter notebooks that I'm going to present later on, and you can play around with that. So if you're interested in, let's say, saving for retirement, or maybe you have also a use case at your job, this is exactly then where you can get started with a sandbox example within Jupyter notebooks that you can execute easily and adjust easily. So again, previously the title was do-it-yourself, so I'm not presenting here some research results which you cannot reproduce. It's all about reproducibility, right? So this slide deck, it's just as background information. I have in the beginning just like one slide about the community. So Meetup events are about communities, but of course there are many online communities, and at the beginning of this year we started a Discord server which has grown to more than 800 members, so obviously completely free to join. We have different channels where you can exchange ideas, where you can ask questions, where you can post events, where you can, I don't know, hint people towards new research that is coming out, and simply general discussions. I also did a webinar series in this context about reinforcement learning in finance. So if you're interested in, use that link. You will also receive, obviously, the link to my slide deck, which is hosted online, and to all my resources. So that's, if you like, more or less asynchronously, while the Meetup events are synchronously, obviously. So here's a link to the resources. That's basically the only thing that you need if you're interested in my materials. It's the bit.ly, the short link, PQF_risk. So the only thing that you need to recall basically is PQF_risk. And there you find the Jupyter notebooks and everything else, like a little data file that I've prepared for my presentation. So I want to contrast in this talk the differences between mean variance portfolio theory, which dates back to 1952 with a seminal article by Harry Markowitz, right, which still today, 70 years later, is kind of like a cornerstone of any finance, quant finance, corporate finance book, right, in the context also with the capital market theories like CAPM and let's say the arbitrage pricing theory or multi-factor models, right? So that's my approach, and the first starting point is mean variance in the sense of asset allocation, and I keep things here absolutely simple. Of course, to everything that I'm going to show you can add more twists, you can make it more realistic, you can add, I don't know, more assets to the universe, but I want to emphasize a few things that might not be obvious to everybody who is following along. Here is the seminal article, and basically it has it all, and I often start when I teach these topics indeed with a 2-asset and a 3-asset example. Here you see the 3-asset example. The only major difference probably is when you see the chart here that today you rather put the volatility on the x-axis and the expected return on the y-axis, but that's, I would say, a minor difference. Again, this is just as background. I don't want to go into the details here. It's rather about the data and the code, and it's just for you that you have maybe some mathematical formulas to what you see in the code, like number of financial assets. We have maybe different points in time, historical returns, mean returns, expected returns, and then we enter already the world where we say, well, standalone, of course, we have a return standalone for every asset. We have some risk, but interesting in a portfolio context. That's the major insight of mean variance portfolio theory a la Markowitz, is the covariance, the correlation structure, right, where we would expect diversification effects, etc., so that we arrive then at the point where we say we calculate portfolio return, portfolio variance, portfolio volatility, and we can then get started with optimizing portfolio composition given different objectives. I will focus primarily on maximizing the Sharpe ratio and basically nothing else. But of course, there might be alternatives. So I want to stick to the, I would say, primary benchmark cases in this context. Before I then want to contrast that with what risk parity would give us. And I have a little twist with regard to crypto, but I focus only on Bitcoin. So a tiny bit of crypto is built in here as well. So the first Jupyter Notebook is about retrieving the data. It has basically nothing to do with what follows, apart from the fact that this is data that I retrieve from, it's basically a paid subscription service. I regularly use data from Refinitiv since years, also for my books, but there are others maybe for, and this is what I have here in mind, maybe for the more amateur retail trader, algo trader, where you get from the company which is called EOD Historical Data. You get for kind of like low subscription fees already a ton of data, including option prices, government bonds, corporate bonds, etc. So just a quick run through. That's not the major point here, but I'm retrieving, and we have a first look at the data via their API. I simply retrieve end of day data, and I will work with 5 years worth of end of day data for Apple, S&P 500, the gold price, and Bitcoin. It's not a large universe, but our pie chart later on will become pretty easy to read. So every once in a while you see here Amazon. I could go here with everything that might be of interest to you. For the sake of my examples, I think that is already good enough so that we here retrieve the data. I cut it at a 5-year point roughly. And when I retrieve the data, we see here in the subplots, I think these are not exotic instruments, so almost everybody, I'm pretty sure, has an idea of how these have evolved over the last 5 years. I just wanted to have something low risk like the gold price or Bitcoin, which is so popular, well, has been so popular, still is, I guess, Bitcoin in the space. Apple, and yeah, the S&P 500. I think that these are very, very standard instruments. And when I plot them in relative fashion, you see like the red and the green one is the index and the gold price, so little risk, little volatility. Apple as a usually well-performing stock on average with a higher volatility, and then we see the high volatile time series here of Bitcoin. That's the universe, 5 years worth of end-of-day data. And I've written this to disk. You don't need to have a token, although they provide free trials with a couple of API requests. But I've written this down and I've posted everything in the gist. So also this data set, you don't need to, basically this first Jupyter Notebook if you want to dive into the other two. They refer only to the CSV file, which is there, which we're going to read obviously with pandas, right? Yeah, that's the basis. Now let's get started with the optimization. We import now from this CSV data file here our, what is it, 977 data points for each time series. Starts here 2019, goes until 15th, so we are pretty current, although for the asset allocation and with the summary statistics this doesn't really count that much. Of course, there might be slight differences when we go to the last day or beginning of the year, that's for sure, but not major ones, right? So the data structure itself, you see here, nothing special, start 2019. It's not even worth, what is it? I said like 5 years. It's a little bit less than 5 years here. As you see, I'm cutting it here to, in this case, I'm cutting it even further. So the data retrieval was for 5 years, but here I'm cutting it to the beginning of 2019. But again, this is just influencing in some way the aggregate statistics and might have a minor impact, but not a major one where we cut here the data. So the returns is what we are working with. I focus here on the log returns. When we have a look at the histograms, we know high peaks and fat tails. That's what characterizes our financial time series in general. In other words, it's not normal. And for example, what I like to teach and preach in trading, algo trading, high peaks mean that most of the realizations are around zero. So we need to get the tails correct, right? I heard G research before, as you heard this, so active in predicting the markets. That's the important part, right? To get the large movements correct. Here we see like over the time period of the data, the annualized volatility, some 34, 23, 16%, 74%, basically what I said before when we had a look. Now the portfolio return, and as a benchmark portfolio, usually one gets started with the equally weighted portfolio. And there's even research which asks the questions and tries to answer the question, why is it so difficult to beat the equally weighted portfolio? Maybe you want to have a look at that, but I use it here just as a standard, quote-unquote, natural benchmark, where we say 4 assets and we put 25% in it. Just as the first pie chart that I'm going to present, that's like equal weight, easy to see. So the portfolio return, here a simple helper function gives us a 23% expected return, which means that's the historical sample return annualized here. But we use this as a proxy for the expected return. The portfolio risk formula is a little bit more involved. We have the covariance structure in here, which I scale by 252 for the trading days, 2 dot products, and a square root later, we are at a portfolio risk of 27%. When we have a look here at the correlation structure, which drives covariance correlation structure, which drives the portfolio risk measure here, we see that some of them are highly correlated, Apple and the S&P 500, no surprise here. Gold is less correlated, close to 0 basically, but on the other hand, still Bitcoin doesn't hold up to its promise in terms of like being a hedge, being not correlated. We see positive correlation basically throughout. We can say with the market, if you like. So the major objective here, as I said, I focus on the maximum Sharpe portfolio, is now implemented as follows. I define the Sharpe ratio without any short rate. Maybe it's time to introduce short rate again, but the optimization wouldn't change with a fixed constant here. And the Sharpe of the portfolio is less than 1, 85.7. And I now define the bounds for the optimization. So I'm not allowing for short sales, let's say, so I keep it simple. I invest 100%, no short sales allowed, and in that sense also no leverage positions. And the major constraint here is that my investments sum up to 100%. So I invest 100%, whatever this is, no short sales allowed. And the optimal portfolio, as you can see here in numbers, is the result. There is already, we spot this immediately, one asset which doesn't appear in the portfolio, and this is nothing, let's say, new, nothing extraordinary in this context. Mean variance portfolio theory is known for many edge and extreme cases. We could, of course, for example, require that every asset, like here, has a minimum of, let's say, 5%, for example. I could set a lower boundary here, let's say like this, that we could make sure that everything is invested at least with 5%, but that's not, let's say, built into the approach. This would be something forced beyond the base optimization. So that's our first portfolio, maximum Sharpe. And when we plot this, we see that we have Apple here with a large part, right? And we have gold, a little bit of Bitcoin, and basically nothing here from the S&P 500. This is what plain vanilla mean variance portfolio theory would give us. Sharpe ratio is quite a bit higher than the original one. Portfolio return 22.8 and 20%. So the risk is much lower than what we have seen from the equally weighted portfolio. I think this shouldn't be a surprise because Bitcoin is here underrepresented and we have gold being overrepresented. But this is again the benchmark output where we say, yeah, that's kind of like the Markowitz portfolio that we get from our optimization. So that's what we want to compare with now when we take the risk budgeting, risk parity approach, which was, among others, pioneered and scaled into the billions, obviously, by Bridgewater Associates, for example, but many others have used it as well. And we now have a brief look. Again, I don't want to go here into the details of the approach, but if you're interested in the details, given my research, what I have screened and scanned, this book is really thorough, comprehensive, and detailed, also mathematically advanced with regard to all risk parity and budgeting techniques. And on top, you get also the basic theory, mean variance, etc. In the introductory parts here. So I'm a fan of this book. It's highly technical and covers quite a few topics, also beyond just risk parity and budgeting. So we still work obviously with weights. We then have some risk measure that we define, and we then talk in terms of risk contributions, for which we then will apply a Euler decomposition, so that we have a sum later on as the risk measure, which we got started with here on that slide, right? We have portfolio volatility, but this is now introduced here. We talk in terms of marginal volatility. So what does a single asset bring to the table in terms of contribution to the overall risk of a portfolio? And we can then derive here the risk contributions of every single asset. So that's not about the euro or the US dollar allocations anymore. It's about risk contributions in terms of percentage points as part of the overall portfolio volatility measure, with which we have worked before. So we won't leave completely mean variance here, but now we go, if you like, a little bit deeper and take a different angle in this context. The disclaimer, as always, important, right? There's nothing that I do here is any kind of investment advice. It's only a technical illustration. So how does it work now with the code? So let me get back. I work obviously with the same data set to have a direct comparison. I have here a little helper file, which is also in the gist. It's just, if you're curious, nothing special, just portfolio return, portfolio variance, and portfolio volatility. That's kind of like a simple Python module from which we can import what we need here. So the universe, you know it, Apple, S&P 500, gold, and Bitcoin. Data I also constrain here to 2019, January and later. The returns is what we need, and we have here NOR, if we're interested in, right? We have 4 assets, nothing has changed in this context. So now the equally weighted portfolio, so that we get started with that again. So we know obviously if we have 100%, 25% in the 4 assets. 3 portfolios, 3 assets, 33%. But here it's clear and easy. We have seen this already, so I repeat this so that we get started now with the equally weighted portfolio. And the question now is, in dollar terms, we are clear, 25%. But what in terms of the risk? And this was one of the final things that we had here, like for that portfolio in particular, it was 20%. For the equally weighted, we had calculated this here with 27%. And the question is now, how much does every single asset contribute in terms of risk to the overall risk position in a marginal way? And of course, given diversification and the background, you've seen it at least before in action, we cannot simply have a look at the volatility for a single asset. We need to consider this in a portfolio and therefore in a marginal context. So we have the covariance structure here, and the portfolio volatility is what I've just shown, calculated before. And if we would like to do something, the question is what would we do with it? But the calculation is simple. On average, the risk contribution is 6.8%. So that's the average risk contribution, but this for sure is not a marginal risk contribution. We see here now the results. You see here the marginal volatilities, and basically what I'm doing here now relates to what I've shown on the slides before, right? Marginal volatilities, risk contributions in percentage points, and relative risk contributions in percent on a portfolio level, right? So therefore here we have this calculation here with the covariance, and do the weighting here with phi, with the portfolio weights, and then I divide by the volatility itself, which I've calculated up here. So these are the marginal volatilities, right? So we see here larger portion, smaller, smaller, larger. So that's like completely different here. It's not the single one here is close to 6.8. That's the average, but these are the real marginal ones. So the risk contributions in percentage points now are 0.05A, 0.01, 0.01, 0.15. So also these numbers now, again, weighted here with the portfolio weights, they give us numbers in a wide range from 0.01 to 0.15. So something like 15 times as large. The one relative risk, or the risk contribution in percentage points compared to the other. When we take the sum of these numbers now, that's the key, the clue. The sum of these numbers now gives us gives us the 27.2%. And equipped with this number, we can now go and calculate the relative risk contributions, right, which then add up to 100%. Did I calculate that? So RRC sum. So this gives us now 100%. And we can compare these numbers now, of course, with a different dimension to the weight allocation, like in US dollar terms. Now we have an allocation to 100% of the portfolio risk. And it shouldn't come as a surprise that it varies. We have seen the numbers here. So for the equally weighted portfolio, 25% is in Bitcoin, but the risk contribution is 58.7%. Not a big surprise, as volatile as it is. Gold has 25, but it's 4.3. Then we have GSPC, the S&P 500, 15%, and Apple 21% overall risk contribution. So this is something that we need to take into account when we put our risk classes on to get a perspective on risk and the risk contributions, that even if we have a feeling that we are well diversified from a US dollar, from a capital point of view, this might not mean that we are well diversified in terms of the relative risk contributions of the single assets. I want to take these, this is like a different way of doing what I've done before already. So the sum of the relative risk contributions here is 100. Risk parity now means that we want to invest in a way that every asset that we have to invest has the same risk contribution. So this will be the equivalent to the equal weight, would be the risk parity portfolio. And I simply put the calculations here together into a function, which I can then use here. You see, when I get this out here, the numbers basically from before. And when I plot this, this is now a repetition from what I've shown before, but based on this function, which does the trick in a single step and not over a number of cells, right? So same numbers as before. The mean squared error now is used as a measure to arrive at a target risk budget. And I want to get started with the risk parity, right? And in that sense, I want to minimize the mean squared error of the risk contributions here as compared to a target. Again, risk parity is just one case. We could come up with other ideas there as well. So here, phi is kind of like a bit far away from that, right? So the target that I want to get started with is 25, 25, 25. So risk parity, and the optimization gives us now the following weights. That's now in weights, right? Because we have started with a fixed risk contribution structure here. And when I plot this, we see now that the risk parity portfolio looks, in terms of US dollar investment, completely different to our equally weight or whatever we had before, like the maximum sharp portfolio. Here we over allocate into gold. We have just less than 10% in Bitcoin, Apple at 17, and S&P 500 like roughly 25% here as well in terms of the optimal portfolio weights. And then we arrive here at indeed the chart that might be confused with the equal weight, but therefore I've put in here the titles like relative risk contributions. And now we have a portfolio given these weights. That was the result of the optimization. This is what we got started with. This just checks whether this is indeed the case, and we get like 25% risk contribution. So given what is important to you as an investor, this might be then the better way, sometimes a much better way to think in terms of diversification, risk, etc., as compared to simply the US dollar investment that you take. This portfolio overall has 17.6% volatility, so it's less volatile. But again, when I take a look here, so much gold in there shouldn't come as a surprise, and much less Bitcoin. So overall, many of the things that we observe might have explained why we have a lower overall volatility. My very last example here is just to show that instead of the risk parity as a target, we can come up with any other target there as well, right? So here, somehow it doesn't, I don't know why this not work here. When you say, for example, the first three assets, 20% each, and I'm a Bitcoin crypto believer, therefore I want to have risk overweight here for the Bitcoin. Of course, this works as well. It's simply another target that is here replaced in the minimize function via the MSE risk contributions function, and the result changes. Obviously, everything else would be a surprise. In that context, we now have a bit more, not that much more Bitcoin, but instead of less than 10, we get 13.7. And of course, the others need to give up a little bit in relation, and the relative risk contributions are now almost exactly, this is numerical rounding here, given the numerical implementation, and we arrive at our risk contribution. And overall, the risk, the portfolio volatility increases as well. Yeah, you see these notebooks don't require anything special apart from NumPy, Pandas, Matplotlib. The data set is there. When you go to the gist with a short link here, I need to go up, it's kind of lengthy. You can either git clone the whole thing, or you can click on download zip, then you need to unzip, but git clone should work out of the box, and then you execute it, and any Python environment with the basics should do the trick. Yeah, that was it from my side. Again, the disclaimer, as usual, everyone should read this carefully. Thanks so much. Of course, I'm happy to take questions if there are questions.
Can you hear us?
Yes.